Well, I'm sitting here with Dan Bernstein. He's an equity analyst at Stifel Nicolaus. He's been covering the senior housing business for 9 years, I guess. 9 years. So let's talk about the state of the public equity markets for senior housing. If you look at supply and demand, there's basically very little supply. So with that imbalance, you would expect there to be huge demand for the public equity stocks. What's going on?
You're talking about the supply of the public equity.
Yes, yes.
Yeah. Well, you have decreasing 10-year interest rates or just interest rates in general, which is, I think that's creating demand for yield-heavy stocks, whether it be REITs or other dividend yielding stocks. But also there's this increasing confidence, I think, in investors in the equity REITs. They've performed very consistently over the last 10 years, increasing their earnings in dividends roughly 7 to 10% a year, and that creates some of its their own momentum.
But on the provider side, we were 20 years ago there were 45 publicly traded provider stocks. Now on the private pay senior housing side there are 3. So there's public equity investors have nothing to invest in. So why isn't there just such strong demand for the 3 remaining ones?
I think it comes down to the real estate value. If you look at the actual growth of the private pay senior housing operators, it hasn't been terribly consistent. Some of that might be the recession, a little bit of oversupply that we saw in construction going into the recession. And so the earnings haven't been particularly consistent. There's a little bit of economic sensitivity that people continue to be concerned about. They're highly levered, unlike the REITs. The leverage, the effective leverage with operating leases at the private pay senior housing operators is somewhere between 8, 9 times, maybe even a little higher than it. And that to the public investor, that's just a big red flag. Maybe to the real estate investor, that kind of leverage is not an issue. 70, 75% loan to value, that's not an issue. But for the public investor and company, whether it be real estate or an operator, that becomes a red flag.
So what's the public investor looking for in the private pay senior housing companies?
Well, aside from the consistency in the earnings, which could help the share prices if you get that, particularly from Brookdale or Cap Senior, where they've had a little bit of inconsistency in the earnings over the last, I'd say 6 to 12 months for a variety of reasons. I think most of the investors I speak to have some kind of real estate angle looking at those companies. Brookdale may own somewhere between, we estimate, $8 to $10 billion of real estate based on current cap rates. Capital Senior Living may own about $1 billion of real estate. We think the implied value of the companies based on that real estate alone is much higher than the current stock prices. And so a lot of investors on the buy side, institutional side, have come up to the same similar conclusions and have made investments in those companies for the real estate value and not necessarily for the operational growth.
And let's talk about something that we haven't seen much of at all, the IPO market in senior housing. I mean, is there any chance in 2015, 2016 we'll see someone wanting to take that plunge, or is it just too difficult?
I really don't see this. Not that there may not be enough large portfolios out there in the senior housing space of quality anymore. We've seen the healthcare REITs over the last 5 or 6 years really buy up most of the assets of the super regionals, which probably would be the most likely candidates to come public. You could see, potentially some of the, maybe more of the B quality portfolios that are looking for capital come to the public markets. But at the same time, why come public? If you look at the valuations of the public operators, they're trading at implied cap rates of 7 or 8%, maybe a multiple. If you want to put a multiple on it, they're trading around 10 to 12 times EBITDA. You can go ahead and sell your real estate to private equity. You can sell your real estate to the REITs. It's something closer to 6 for a large portfolio, maybe lower nowadays. And if you don't want to go ahead and sell to a REIT, you can go ahead and refinance with Fannie Mae, Freddie Mac. The insurance companies are starting to lend to the industry at high 70% levered LTVs. You can take out most of your equity, pay yourself back, and why be beholden to a REIT or some or an operator?
And not deal with all the requirements of being a public company, the extra costs.
Yep.
What about the skilled healthcare Genesis reverse merger? Is that going to put a little more, fizz into the skilled nursing market, the public equity skilled nursing market?
Well, at the very least, it brings back a very sizable company to keep track of within the industry. I mean, if we don't look at the other post-acute operators like Health South or Kindred, and just purely more at the skilled nursing operators, looking at market caps below $1 billion, Genesis Skilled Healthcare is going to be quite larger than that. Genesis is obviously one of the largest, not the largest skilled nursing operator in the U.S., and so it puts a very good mark, to keep track of the industry, what trends in the industry. It brings some excitement back. I mean, we haven't seen that sizable of an operator in quite a long time.
And you bring up Kindred. I mean, what don't investors get about Kindred Healthcare right now? I mean, shouldn't they be kind of clicking on all cylinders with their whole post-acute ACO model that they've been working on? What's going on there?
Well, it's a complicated company. You end up, I think the easiest way to say it is they actually run multiple business lines. It's all post-acute, skilled nursing, and inpatient rehab, long-term acute care hospitals. Those are really all different businesses. They have different regulatory dynamics and behind them. That might change, and I think that's why Kindred has built the company the way they have. They expect to see more site-neutral payments, more pay for quality. They're able to build more relationships with hospitals, insurance systems, to reduce rehospitalizations. And I think all of that works out over a long period of time. We're only starting first to see now the proposals for site-neutral payments. We're really only first seeing the dynamics changing perhaps in their favor. It's a company really built for several years from now, rather than a company that's built for today's regulatory reimbursements.
Well, that's what I don't understand, because the price seems so low. So if that's true, buy now and then ride it up, whether it's 1, 2, or 3 years from now. But who knows? So let's look at with REITs with their low cost of capital, their really low cost of capital, their diversification in property type, diversification in geography, in everything pretty much. What's going to keep the REIT train from rolling on? I mean, is this just going to keep on going forever?
Well, it can't keep going on forever. You end up with a lack of quality in assets. But we estimate the total real estate market, which would include seniors housing, medical office buildings, life science assets, skilled nursing, all the different hospital classes. Perhaps $1 to $1.2 trillion investable. Maybe something a little bit smaller than that. $800 billion, somewhere in there. They only own 10% of that or so. So they actually have a lot of assets, and that's just in the United States. They've very obviously expanded now internationally, in the UK, Canada, mainland Europe, and Germany. We could even see some investments in Australia at some point. So there's a lot of assets for them to buy. The key for them will be continuing low cost of capital. Interest rates, 10 years at 2%, a little bit below that. As long as there's not a rapid rise in interest rates, their cost of capital will stay very low, and will continue to be aggressive buyers.
Yeah. Well, we'll see what happens with that record year in 2014. We'll, in terms of the acquisition market and values, we'll see what happens in 2015. But I don't know about you, but I'm just assuming it's going to be a repeat or even more.
We expect a repeat.
Expect that? Okay. All right. Well, keep up your good work, and I look forward to reading the reports.
Thank you.
Okay. Thanks.